Hello and welcome to the investment update for January 2026. My name is Michael Ogg. I'm joined here by Marc Wait, Chief Investment Officer of Providence. Welcome, Mark.
Thanks, Mike.
Now, Mark, it's been another extraordinary year where the headlines have been, less than calm, let's say, and yet asset prices have performed pretty well. What's behind that and what's been driving this resilience?
Yep. Well, I think as sort of Warren Buffett says, people have emotions, but when you're in the business of investing, you need to leave those at the door. And so I think there was a lot of things to get worried about last year, particularly with the sort of the geopolitical developments. But I think as we sort of highlighted last year, we believe there was some really sort of solid foundations around the investing environment at that point in time. And what do we mean by that? We mean it was an environment where you basically had reasonably good economic growth, you had inflation starting to come down. If you looked at valuations in some markets outside of the highly valued technology sector in the US, there was some reasonable valuations there. And interestingly enough, having had a period where earnings have been quite soft, you started to see an improvement in the trajectory for earnings as we look forward. So I think in that environment, it was an environment where people were happy to put capital to work. And we had some sort of pretty solid returns as we sort of closed out 2025.
And Mark, this quarterly's Global Outlook and Strategy is the 100th edition. So congratulations for that. That's quite a milestone. 100 editions. The title's Passing the Baton, which is an interesting one. Can you talk through what you mean by that and why is it relevant now?
Yeah. So I think if you think about leadership in markets, you've seen an environment of this sort of period of US exceptionalism. We'll talk about that a little bit later in the podcast today. But I think what's important is if you look at the valuations of some markets, they're quite high. And we know that sort of in the short term, valuations don't matter too much for performance, but over time they do tend to become a little bit of a headwind for performance. So we think that A, that's important. We think B, then the point that we made in the sort of opening comments is there's some pretty positive prospects outside of the US. And C, I think following a period of some pretty solid returns, we're going to have to work pretty hard to get good returns going forward. So we've had 3 years of really good returns from an investment perspective, and we'll need to have a really sort of sharp eye on valuations going forward and have really good diversification within portfolios to sort of manage the period ahead. I mean, essentially what we're saying is we think it'll be an environment where you'll see continued volatility and perhaps even a little bit more volatility because of heightened valuations in some markets.
And Mark, just on US exceptionalism, I mean, US has been the best place to invest for probably 15 years or so. So why is this time different? What's changed in the last couple of years?
There was a great quote in one of the outlooks that was from a Bank of America strategist, and her sort of view was reviewing all of her valuation metrics for the US market. She came up with a pretty nice one-liner, which was, there's no way to sugarcoat it. The S&P 500 is expensive. And it was expensive on 18 out of her 20 measures. Right. So I think valuations really matter, and that matter a lot for us at Providence. So I think that's important. I think the second thing is, if you think about what are the elements of growth in the US, you've seen quite a concentration of growth. You've had what people have talked about as the K-shaped economy. You've seen really strong investment in the AI space, but you've also seen some weakness in the lower parts of the economy as well. So I think sort of high valuations and also just sort of going forward opportunities elsewhere means that in a way, the opportunities to invest see the baton being passed and sort of moving forward. And that's why we think that sort of potentially has some question marks on US exceptionalism going forward compared to those last very strong 15 years. And when we look at markets outside the US, we think there's some really good opportunities there still.
Yeah, thank you. And I mean, just stay with the US for a second. I mean, the AI has been also a big driver of the US and the US economy and what have you. And there's a lot of CapEx spend, etc. And people are talking about that being in a bubble. What's your view on that?
Yeah, I mean, there's no doubt this is a generational moment in terms of the size of the CapEx expenditure. So if you look at the hyperscalers in the US, I mean, they are very much investing quite strongly. And as we've sort of talked about, in a way in which some of this investment is stay in business investment. And there's also quite a lot of uncertainty around what the return on invested capital will be for that investment. So if you look at the size of the investment from the chart that we put on the screen, you're seeing that a lot of those hyperscalers have moved from reinvesting around about 10% of the cash flow from operations to now investing 70%. Mm. And indeed, you've seen a lot of volatility in some of the shares of these different companies. Oracle would be a really sort of key case in point. The stock went up substantially, and since its peak in the sort of third quarter has essentially halved, because as people have sort of looked at the increasing debt burden for the companies as they invest in that space. So we think it's an important moment for the economy. The question is really, what's the returns going to be on that? The challenge from an investing perspective is in our GOS this quarter, we actually put a number of quotes from some storied investors, and one was Howard Marks of Oaktree. The other was from Paul Tudor Jones, and the third was from Ray Dalio. And Ray Dalio is probably the shorter one, which we can talk to. And he basically said the picture is pretty clear. We're in the territory of a bubble. Mm. We don't have the pricking of the bubble yet. Don't sell yet because there is a bubble. So essentially what they're saying is this could continue going for a little bit longer, but you need to be aware. And I think, as sort of Howard Marks said as well, you don't want to be all in on this trade at this point in time, particularly when there's some interesting opportunities elsewhere.
Sounds like a watching brief.
Great.
Yeah. And just on the recent start of the year, so a fair bit of geopolitics, Venezuela, the protests in Iran, Trump now turning up the heat on Greenland. And markets seem to have digested this reasonably well. Can you just talk to that?
Yeah. So I think it's quite interesting. And maybe it goes back to that line that we had before, which is the sort of solid foundations in terms of markets. I mean, we do think that a lot of this noise might not be at its end yet. And you've seen sort of quite a strong start to markets, particularly equity markets at the start of the year. And more recently, you've seen a little bit of a pullback in that space. Some really interesting dynamics. I mean, if you look at the volatility, it shows you some of the uncertainty. So when the activity occurred in Venezuela, people focused at all the extra oil that was going to come to the oil market. There was a sharp move lower in the oil price. The oil price is now up 5% for the year. And that's really just around some of the fears in terms of Iran, that you might get some action there. So there's a lot of noise around oil prices, and you want to watch that closely. I think the second thing is an asset class that we've liked for a long period of time and has been in our portfolio since 2019 is gold. And the gold market sort of coming off a pretty strong 2025 has sort of started the year pretty strong again. So that's up 10%. And that's very much sort of the instrument of choice as a geopolitical hedge. So I think that geopolitical uncertainty really manifests itself in the gold price. And you've seen some reasonable sort of expectations for gold price appreciation this year. And from our perspective, we have a watching brief on it, to use your terms, but we also sort of think it's a realistic and a reasonable geopolitical hedge that's sized appropriate within clients' portfolios and provides some really good protection.
And Mark, just moving to productivity, it's a theme that you've been talking about, your global productivity. Yeah. The US has got very high productivity, Australia not so much. How are you seeing all that playing out in terms of productivity?
So I guess it's really a story of the haves and the have-nots. So if you think of the epicenter of the sort of IT and the sort of AI and the automation and the e-commerce sort of step forward in terms of productivity, that's very much front and center in the US. And so we'll show a chart on the screen, which I think really tells the story well. If you look at the IT sector, they've essentially been shedding jobs for the last 2.5 years, yet profits have continued to grow pretty strongly in that sort of environment. So it's clear that sort of movement in automation is stepping forward, and you're starting to see that move into areas like professional services, other sectors there. I think also in the US, you've had this sort of flexible labor market, and people thought that the sort of immigration restrictions that the Trump administration were putting in place were going to be quite difficult and maybe quite inflationary. But it's interesting, actually, where you've seen this sort of job shedding that's been occurring or reduced hiring environment. It's probably actually been a little bit of a prescient move. And that flexible sort of labour market, the way in which the US adjusts, is really helpful. I mean, unfortunately, in Australia, we're a little bit more a follower, and hopefully we'll be a fast follower in terms of improving productivity. But we've gone through a pretty slow period of productivity across the economy. Zero productivity growth to the end of sort of 2024 over sort of a 6-year period, and still pretty muted levels of productivity at the moment. And that's really sort of been around a less flexible labour market. We don't have such a big IT industry, and we've probably been a little bit slower to adopt some of the sort of step forwards that you can have in e-commerce and automation and in sort of services sector.
Okay. Just moving on to emerging markets. Emerging markets is a theme that we've been talking about now for 6 to 9 months. Yep. It's been an asset class which has kind of been overlooked, I'd say, for a long time. Why do you like emerging markets, and what are you seeing here?
So we think it's a much unloved asset class. I mean, it went through a very difficult period. Sort of, if you think about where we were in the 2000s, it was a loved asset class. It was a way in which of playing the China boom. Sort of was a way in which you're playing globalization. And then post-financial crisis, you really had that sort of environment of a lack of globalization or an element of deglobalization, some relatively unstable institutions in a lot of the emerging markets. And I think what's really happened over the last 10 years is you've seen them put their house in order from sort of central bank policy perspective, fiscal policy perspective. If you talk about worries about government debt, that's far more a concern in the developed world now than the emerging market world. Whereas if you think about the early parts of our careers, it was very much more a concern in the emerging markets. So that's been quite good.
Mm-hmm.
I think as well, sort of as you have a fragmented world, it's actually played into the emerging markets. So if you think about that sort of Asian trade bloc for emerging markets, there's a lot more trade going on in that region than there had been historically. It's a lot less sort of US orientated in terms of the trade patterns. And then also what's been quite interesting is it's been a cheaper way to play tech. So if you think about the technology sector, there's some really interesting technology companies in China, the sort of most important chip manufacturer in the world in Taiwan in terms of TSMC, some really good developments in South Korea. So all of these great opportunities come at a reasonably low valuation, having gone through a period of derating for 15 years. So we look at it and we say strong earnings growth, trades at a discount to the market, relatively under-owned by global investors. And we do think it's an asset class that can continue to have good performance after the good sort of turnout that it had in 2025.
And Mark, just trying to encapsulate all this of valuations, geopolitics, and what have you, shifts in the portfolio. How is the portfolio position at the moment, and how are you seeing things?
So, I mean, the headline is we think it's a really opportune time and you're getting paid to diversify well in portfolios. So what does that mean? We continue to be overweight growth assets and slightly underweight defensive assets. Within that sort of growth mix, we like international equities, and we're quite overweight international equities compared to Australian equity market where we don't see as many opportunities. And I think within that international mix, we've been really deliberate about the way we've structured our international equity portfolio. So we talked just now about emerging markets. That's probably one of our favoured asset classes. We've also been pretty committed to Japan for a period of time, and we like the market as a whole, but we like activist investing in Japan even more.
Mm-hmm.
And we see there's continued opportunities there. Japanese companies have quite a lot of cash on their balance sheets. The private equity titans like KKR are active in that market and looking for opportunities to take companies private. So there's lots of exits for our activist manager. And we think there's some really good alpha opportunities there. And then we also like global mid-caps. And so that kind of puts us as a little bit underweight the US, or reasonably underweight the US, to sort of address some of those concerns that we have on valuation.
Mm-hmm.
And then outside of equities, if we look at some other asset classes, when we look at sort of infrastructure and property, we've been leaning into infrastructure as an asset class, both listed and direct. We feel as though that's got a really interesting way to play around the energy transition, digitalization of the economy, some of the things that are going on in terms of data centers where you're more a provider than necessarily having a lot of risk capital there.
Mm-hmm.
In the property space, we've sort of seen a little bit of a bottoming in terms of that property cycle, probably about 18 months ago. And we continue to be pretty selective, but we're seeing some interesting opportunities on a selective basis in the property space. And then finally in credit, there's always going to be some wobbles in credit and always sort of some concerns. But if you look at the sort of returns that you're getting there, we still think they're reasonably attractive relative to cash and relative to things in other sort of asset classes. So we've got a modest overweight to credit in that space. And what we'd always sort of emphasize is it's really important to have the right manager who's been through multiple cycles, understands workouts, does good credit work, is very selective about where they put capital to work. And then I think the second part that we must talk about is in terms of how we're positioned in terms of defensive assets.
Yep.
And so we mentioned before gold. So we continue to sort of watch gold closely, but feel as though the modest allocation that we have within portfolios is a good sort of stabilizer for portfolios. We've got a modest overweight to cash. And then the fixed income asset class is getting more interesting. So if you think about this year, there's a bit of a divergence in terms of central bank policy. Markets are pricing in hikes. If you look at Australia, there's somewhere between 2 and 3 interest rate increases priced in. We don't see that moving too much higher from this sort of environment. And we think that sort of fixed income over time will play a more interesting role within portfolios. So if we'd sort of looked over the horizon, we'll probably be starting to increase our weighting in that sector.
Mark, thank you very much. Thank you for your time.
Thanks, Mike.
And thank you for watching. I hope you enjoyed the discussion. If you do want to have a chat about any of the themes or you want to chat about anything further, please don't hesitate to reach out to us at Providence. Until next time. Thank you.